As Jerry mentioned, big banks kicking off the official start to earnings season. The earnings coming in very strong. Overall, analysts anticipate that earnings for the S&P 500 companies will be up a booming 18.4% from last year, and investors are upbeat. So is it a strong economy, tax reform, or something else that deserves the credit for investor enthusiasm? To my markets guest, Jimmy Lee. He is the CEO of the Wealth Consulting Group. Jimmy manages $1.3 billion in assets under management. Jimmy, so far it's very early to call this earnings season a success, but do you think it will soothe investors, given the fact that the markets have been so rattled by inflation and interest rate worries in early February, moving on to trade tensions in more recent weeks? Can we get back to the fundamentals, and will we see calmer markets prevail?
Dagen, I think we will, and thank goodness for the fundamentals, so you can get off some of this headline news
right.
that you've been referring to, with the trade wars and the data privacy issues and Syria. And is it me, or is every software company sending all their privacy notices right now after Mr. Zuckerberg testified? But I do believe that
yes, I left that out. I mean, that was the headline of earlier in the week, but continue.
I do believe we're going to have good earnings, and as you said, led by financials and the banks. We've had some earnings already come out, and I think very positive, and I think it's going to be even more positive as we hear more companies announce next week. As the tax reform really takes hold, I think it's going to really it's going to prove to be positive for companies, and not just this quarter, but throughout the remainder of the year. So yes, happy that earnings season is here, and I think it will soothe some of the investors' concerns about the headline news that we've been seeing.
Can you remember a time, and I've been in this business a long time, probably about a quarter of a century, being a financial journalist, but can you remember a time when the markets were so driven by headline risk and anything seems to introduce uncertainty rather than an economy that's expected to grow at 3.3% this year? That's from the CBO this past week, and earnings that are growing at the fastest pace since, I think, 2011.
Yeah, I think headlines always drive the market in the short term, but I think that's what's important for longer-term investors that are watching this show. You're not a trader, and so don't pay attention to that too much. I think that for the remainder of this year, what's important, Dagen, is that the stock market's probably going to be very volatile. I do see us hitting new highs at some point, who knows when, maybe even soon after this earnings season, but I can see even more corrections to follow. So the picture I like to try to paint for the viewers is, for the stock market for the remainder of the year, is imagine somebody walking up a flight of stairs, maybe not that steep, but the key is walking up, but with the yo-yo, and that yo-yo representing the stock market. So prepare for volatility. I think it's going to be very important for investors to keep their emotions in check and make sure that they don't make any mistakes during those volatile times.
Jimmy, how is the stock portion of your portfolio allocated at this point? Is there any one sector that you are wildly underweight or even avoiding at this point?
Well, it's a big asset class, but we're very concerned about bonds, and we think that we need to position our portfolios for a rising rate environment, not necessarily inflationary, but we've increased our allocations to emerging markets, commodities. We do like the financial sectors, but for longer term, we're really concerned about the returns that investors are going to get from bonds, especially retirees that are depending on returns from fixed income to live on.
Well, given the ultra-low interest rate environment and the unprecedented monetary stimulus from not just our Federal Reserve, but central banks around the globe, it was those very savers who really got stuck in the last decade or so. For people who need yield, where should they go here and that could give them some modicum of safety?
Well, I think people need to be not chasing yield ever, right? So I think they should be considered not necessarily for yield, but for total return. What I'm really concerned about, Dagen, is the financial plans of many Americans. The assumptions that they use for their stock and bond returns might be inflated. Most financial planning software uses historical data, and if the experts are right and we get much lower returns for stocks over the next decade and a lot lower returns for bonds, investors really need to take a look at their financial plans to make sure they're using the right assumptions. They might have to increase risk and or use alternative strategies to their traditional stock and bond portfolios in order to get the returns that they're looking for.
Thank you, Jimmy Lee. Take care. We will see you soon.